All right, hello everyone out there. Today I wanted to go over a financial concept related to retiring and retirements called the Trinity Study. And some of you may know this study by the name of the 4% rule. That's a more common name for it. But this was a study that was basically facilitated by three professors from the Trinity University out of San Antonio, Texas. Professor Cooley, Professor Hubbard, and Professor Waltz. And basically, this study was a study that they did so that they could figure out how long you could sustain your retirement nest egg, basically. So if you had a certain amount of stocks or a certain amount of bonds or a certain combination of those, depending on how long you wanted to sustain it, they wanted to know, well, how much could you take out every year? And depending on how much you took out, how long would it last? So they basically took the stats from from 1925 up until 1995. Or I'm sorry, 1926 to 1995. So roughly close to 70 years of information and data based on the stock market and the bonds market. So basically what they came up with was a chart where you could basically see how well you would have done based on how many years you expect for your retirement to last, how much money you would be taking out percentage-wise out of your nest egg, and what combination of stocks and bonds, or just stocks or just bonds that you own. All right, so today we're going to go over a simple example of that, and we'll start with a good round number. Let's say you have $1 million. You take the $1 million and you're able to take out, basically you want to take out 4% per year, because let's say you hypothetically can live off of $40,000 a year, which 4% of $1 million would be $40,000 a year. Okay, based on their data, if let's say 100% of that $1 million is in stocks, they're claiming, or at least stocks that are, robust stocks, such as stocks that are based on the S&P 500. I'm not telling you to put it into something that's super volatile. But let's say you're following the S&P 500, you put it into those stocks, and you want your money to last. Let's say you want it to last for between 15 to 30 years. There's almost 100% chance that you will succeed with this. Based on their charts, at 4%, if you wanted it to last for 15 years, you have a 100% chance. If you want it to last between 20 to 30 years, you have a 98% chance. And then they also broke down other percentage levels. For example, let's say you took out 8%. According to their rules, if it's 100% stocks, you'd be looking at a 93% chance. If you had 75% stocks and 25% bonds, at 8%, you'd be looking at 94% chance of it succeeding. Now, the other thing that we have to keep in mind when we're looking at these stats is the idea of inflation, because there's always going to be inflation, probably even more so now than it's been in the past. So you have to, whenever you're using these stats, they also included a caveat. As the years go by, to keep up with inflation, as far as your ability to have the buying power that you would have had if it wasn't inflated, you're basically going to have to add a little bit more to the amount that you take out every year. For example, let's go back to the $1 million example. Okay, 4% out of the $1 million. Okay, you're looking at $40,000 the first year you take it out at 4%. But let's say throughout that year, that first year, everything inflated by 3%. If it inflated by 3%, then that next year, you wouldn't take out just $40,000. You would take out basically $41,200. So you would add $1,200, which is basically 3% of $40,000. On that third year, you would take out $42,436 if it raised another 3% again that following year after that. So that's another thing that you have to look at when you're looking at this, because 20 years from now, you may need more than $40,000 because of inflation. So that's basically the gist of how the Trinity Study works. And it's something that I've been looking at for probably the past couple of years. I haven't retired yet, but this is something that I plan on following because, I mean, from everything that I can see and all the research that I've done on it, it seems like a legitimate and viable way to operate during your retirement years. And it gives you a very grounded and tangible way to look at your retirement. You know, many times we just accept whatever we receive at the end of our retirement and hope that it works. But I feel as though that's not the right way to go about it. We need to have some type of plan so that we can execute properly and not worry about depleting our resources during retirement. So thank you all for sitting and listening to what I have to say about this study. Please like and subscribe, and I appreciate you all. I look forward to seeing you again. Thank you.